This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do.
Growth spurt. The economy is picking up, but most Wall Street forecasters don't see the economic boom that the president-elect and his team expect.
The ties that bind. Can the U.S. forge a new economic relationship with China, one of its most important trade partners?
Modern medicine. Predicting the next epidemic is no easy task, but the medical community is working together and making advances like never before. Those stories and more tonight on Nightly Business Report for Thursday, December 22nd.
Good evening, everyone, and welcome. The economy is feeling the holiday cheer. Economic growth defied forecasts for the third quarter, coming in stronger than previously thought. The gross domestic product, the broadest measure of goods and services produced in the country, grew 3.5% from July to September. That is the best quarter of growth in 2 years. But despite the strong report, the overall reading for 2016 is not expected to impress. In fact, the Federal Reserve sees the economy growing about 2% for years to come, and many Wall Street economists tend to agree. But the president-elect has a different view. Steve Leisman takes a look at the diverging outlooks.
When President-elect Donald Trump introduced his economic plan, he boasted this.
We're bringing GDP from really 1%, which is what it is now, but we're bringing it from 1% up to 4%, and I actually think we can go higher than 4%. I think you can go to 5 or 6%.
Wall Street economists, having plugged those plans into their models, aren't nearly so optimistic. They don't see 6, 5, or 4% growth. They don't even see 3. The average of 13 economists polled by CNBC sees gross domestic product coming in at 1.7% this year, rising to 2.3% in 2017, and then just to 2.5% in 2018. So there are some gains, but not nearly as much as the president-elect estimates, at least not in the first couple years. Some economists say they don't have enough info to make a detailed forecast, or that the programs won't have the size or the bang that Trump projects.
Tax and spending only. We had add to growth about 20 basis points per year. So if you take some fraction of that in any given year, even if you take the whole thing, in our opinion, it doesn't add up to a whole lot. We can revisit the number if the plans turn out differently than what were projected.
Virtually all economists point out that there are positives and negatives, or a red light, green light aspect to Trump's policies. The positives include infrastructure spending, deregulation, and business tax cuts. But economists worry about higher inflation, higher deficits, and even a stronger dollar. The big negative? Trump's trade policies are forecast to subtract from growth. Trump advisor Kellyanne Conway said, don't sell Trump short on his economic goals.
Every time people bet against Donald Trump, they're quickly and sorely disappointed, and I think economically that's true as well.
But this is more than a contest between the president-elect and economists. It's more between the optimistic stock market and the less upbeat view of the economists. If economists have it right, then the market could be baking in more growth than Trump's policies can deliver. For Nightly Business Report, I'm Steve Leisman.
Since the election, the Dow has climbed more than 9% on expectations of reduced regulations, tax cuts, fiscal stimulus. But is Wall Street not fully understanding the Trump team? Eamon Javers is in Washington. And Eamon, is it possible that Wall Street is not understanding the incoming administration? And if so, how?
Yeah, hi, Tyler. Well, I talked to somebody this week who is very familiar with the Trump transition, who said that doesn't necessarily think that Wall Street understands exactly what Trump is doing here. They're sort of operating under the assumption that this will be a lot like Republican administrations that we've seen in the past. That's not necessarily the case. This person saying bowing at the altar of free markets is out. That is, Republicans in the past have defended companies and executives in the C-suite who've done things like offshoring jobs, tax inversions and the like. That That will not necessarily fly in a Trump administration, this person said. Said very much this is not going to be a traditional Republican government, and citing Trump's ability to go after and tweet after specific individual CEOs of specific individual companies. And Tyler, I should tell you, we got another example of that just this evening from Donald Trump, who tweeted out, based on the tremendous cost and overruns of the Lockheed Martin F-35, I have asked Boeing to price out a comparable F-18 Super Hornet. So there you see Donald Trump pitting Boeing and Lockheed Martin against each other in these years-long defense projects. That's not something we've seen before from a president-elect or a president of the United States.
Right. It certainly isn't. Can we, from the statements that we've heard not only from the president-elect but from the person that you talked to earlier, is it possible to start figuring out who the corporate winners and losers might be in this new administration?
Sure. This person said that the people who are going to be the big losers are crony capitalists. He said if you go to sleep at night and you think you might be a crony capitalist, then you probably are, and you better not sleep very well under a Trump administration. So figure out what crony capitalist means in Donald Trump's view, and then you might have a sense of who the winners and losers are.
All right, Eamon, thank you very much. Eamon Javers in Washington.
The strong report on economic growth didn't help the stock market much. The Dow retreated further from the 20,000 level and suffered its first back-to-back loss in 6 weeks. The blue chip index dropped 23 points to 19,918. The Nasdaq was off 24, and the S&P 500 fell 4.
China's foreign ministry says Beijing will monitor the policy positions of the incoming Trump administration, saying as two major powers with broad mutual interests, cooperation is the only correct choice. The statement comes as Donald Trump appoints Peter Navarro, a longtime China critic, to run a new trade policy office in the next White House. And in a recent interview on CNBC, Navarro talked about trade with China.
What Donald Trump has said is that we are going to use tariffs as a negotiating tool, not an endgame, as a negotiating tool to force countries like China, half of our trade deficit, and he's called them the biggest cheater, he's right, to force these trading partners to stop their currency manipulation, their illegal subsidies, to stop the intellectual property theft that takes $300 billion out of our economy.
As we reported yesterday, Donald Trump also named billionaire investor Carl Icahn a special advisor. In an interview today, Icahn highlighted a trade war with China as a potential risk to the market.
Obviously, if you get into a trade war with China, and sooner or later, I think we're going to have to come to grips with that, and maybe it's better to do it sooner, but that's not my decision at all.
Donald Trump has threatened to impose a tax on Chinese goods and labeled Beijing a currency manipulator.
Our next guest says a trade war with China and perhaps more is coming. In a phrase, he says, buckle up. Scott Kennedy is director of the Project on Chinese Business and Political Economy at the Center for Strategic and International Studies in Washington. Mr. Kennedy, welcome. Good to have you here. When you say a trade war with China and perhaps more is coming, what is the perhaps more you refer to?
Well, we're certainly seeing, since the election, Donald Trump being willing to push China's buttons on a whole variety of issues, not just on trade issues, which were the topic of the campaign, but we've seen him push on Taiwan, on the South China Sea. He's talked about North Korea. There's certainly other areas which he could push, and he's certainly allowing economic and security issues to mingle in a way that we haven't before. So it doesn't look like we're just gearing up for a traditional tete-a-tete on specific economic issues, but a broader conflict.
It also goes to the team that he's put together, does it not? It's a hardline team. I mean, Mr. Navarro has had some very strong words about China. So it's not just the president-elect, but it's those who are within his cabinet and advising him.
Sure. I think if you have a chance, I mean, any professor would love folks to go out and buy their books, and now there's a good reason to buy what he's written. But if you'll see, for Navarro, China is not a problem. It's the problem that the United States and the global economy faces and needs to be tackled front and center. I think everybody's been frustrated with China the last several years and thinks that more action is required. It just looks like, Donald Trump is amassing not only the team, what includes Navarro, but the weapons to push China on many fronts all at the same time.
Is Mr. Trump right? Do the Chinese cheat? And if they do cheat, why shouldn't we push back?
Sure. I think it's definitely true that if you look at, subsidies, other types of Chinese industrial policies, lack of market access, yes, there's ways that the Chinese are not meeting their commitments that they've made to the U.S. or to the WTO. The question is, what's the best response? Certainly strategic patience, which the Obama administration has applied, hasn't worked quickly enough. But do you go to the other extreme, which Trump seems to be suggesting, sort of an all-out trade war, all or nothing? Or do you try and be more careful, prioritize what you want to achieve, and aim for some middle ground?
All right, Scott, we have to leave it there. I'm sure it's going to be an ongoing conversation. We hope you'll join us again. Scott Kennedy with the Center for Strategic and International Studies.
In a tweet this morning, Donald Trump called for more nuclear weapons. He said, quote, "The United States must greatly strengthen and expand its nuclear capability until such time as the world comes to its senses regarding nukes," end quote. Upgrading the country's nuclear arsenal would be a costly proposal involving more spending on defense, and that's a sector that, as you probably know, he has paid particular attention to recently. And as Morgan Brennan reports, for investors, nukes carry a lot of not so obvious risks.
What's the best defense against Twitter? That's what investors are trying to sort out when it comes to defense. Take Lockheed Martin, which has fallen 2% since President-elect Trump tweeted about the F-35 Joint Strike Fighter program's, quote, out-of-control costs. On the heels of a meeting with Trump yesterday, CEO Marilyn Houston said the two discussed Lockheed's progress to already bring the price tag down with, quote, continued commitment to delivering an affordable aircraft to the U.S. military and allies. It's a similar story for Boeing, which also met with Trump about the cost of replacing Air Force Ones, after it, too, was the subject of a tweet. Boeing stock has recently fared better than Lockheed's, but experts say these events could signal a shift in how the new administration plans to do business.
Lockheed and Boeing have many, many, many defense contracts. Some of them are coming in the future, and that gives a president or something of his ability, the ability to negotiate things. You want some changes here, then you're going to have to give us, something going forward. So there's always negotiating room.
And future defense business will be key. Defense spending is expected to increase both here and abroad. Trump has vowed to rebuild the U.S. military, but analysts say it's also cyclical since it trends in 20-year cycles. That's helped propel defense stocks, with the S&P Aerospace and Defense Index soaring 22% this year and 10% just since the election. Even factoring in the 140-character risk, many analysts insist the sector's still a buy. R.W. Baird's Peter Arment has outperformed ratings on many of the stocks he covers, including on Lockheed and Boeing. And Buckingham Research's Richard Safran likes Lockheed, General Dynamics, L3, and Raytheon, which could also benefit from international spending. Another area in focus, America's nuclear arsenal. As Trump tweets about the need to, quote, strengthen and expand the country's capability, which the Pentagon's already moving to modernize. That could benefit General Dynamics, Northrop Grumman, Raytheon, and many more. For a Nightly Business Report, I'm Morgan Brennan.
Still ahead, not all dividend stocks are created equal. Why you have to be even more selective when looking for stocks that pay you back.
Yum Brands is declaring a quarterly dividend of 30 cents a share, its first dividend since Yum split off its China business last month. That represents a 1.9% yield. Shares of Yum are up more than 20% so far this year. And dividend stocks have rallied this year thanks to low interest rates. They were more attractive than bonds, certainly. But with the Fed expected to raise rates next year and Donald Trump's massive infrastructure spending plan, does it mean you need to be more selective with dividend stocks? Hugh Johnson, chairman of his own asset management firm, Hugh Johnson Advisors, joins us now to talk about that. Good to see you, Hugh. Happy holidays.
Nice to be with you. Thank you. Happy holidays, Sue, Tyler.
So you say there are dividend stocks and then there are dividend stocks, and you have to be selective and aware of the components of those particular stocks. Tell us a little bit more about that.
Well, what I'm saying is, there's stocks in certain sectors of the market that pay very high and attractive dividends. That would include companies in the telecommunications, utilities, consumer staples sectors of the market. They're very high and very attractive, and they will work. Those dividends will work, and those sectors will work if we're headed towards an economic recession accompanied by a bear market. But that's not what we're in, and that's not where we're headed. So we're headed towards let's call it a positive economic environment, which means you might want, instead of choosing companies that offer high dividends, get companies that offer lower dividends but will grow those dividends. And that comes from different sectors. Right now, with Trump coming on board, that might include the financials, the industrials, and the technology companies, which will benefit from the plans that Trump has. So high dividends don't work in this environment. Lower dividends, where dividends will be increased, work, and that's where you should focus your attention.
You mentioned J.P. Morgan, General Electric, United Technologies, even Microsoft in these categories. These can be growth plays as well as dividend plays.
That's exactly what I'm saying, Tyler. I'm saying companies, those are all companies that are going to benefit from, let's call it the Trump bump or the Trump plan, which means if you take financials, for example, and you start to dismantle Dodd-Frank, or if you have rising inflation, rising interest rates, a steepening yield curve, that's going to help banks make a lot more money from their commercial lending portfolios. So they're going to benefit from Trump. You know, General Electric, United Technologies, that's aerospace, that's infrastructure. When you look at Microsoft, Cisco, even Apple, they're going to benefit in different ways from an expanding economic environment. So not only are they going to pay attractive dividends, they're going to increase those dividends over time, and that's what you want in this kind of an environment.
All right, to turn you now to the overall market, we have had quite a rally, post-election rally, Hugh. How does the market look to you at this juncture?
Yeah, we've had a big move, Sue, on the upside, and you know that, and your common sense alone, as well as my number crunching, says that we've moved to a level that's pricey or overvalued. We're about 3.5% overvalued as I do the numbers. That means that it's not particularly attractive. The upside potential is not particularly attractive, is not that enticing when I look at where we're going through 2017. Okay. So under those conditions, dividends will count. But again, the kind of dividends you pick, the kind of companies that pay the right kind of dividends, lower dividends, or grow those dividends is where you want to be.
Thanks, Hugh. Appreciate it. Hugh Johnson with Hugh Johnson Advisors.
Fewer customer discounts translated to fewer sales at Conagra Brands, and that's where we begin tonight. Market Focus. The maker of Slim Jim snacks and Peter Pan peanut butter missed revenue estimates, but did manage to post better than expected profit. The company plans now to invest in new ingredients for its products. Don't change those Slim Jims. And advertising for some older brands. Shares rose more than 3% to $39.29. Rite Aid saw both profit and sales fall in its latest quarter. The drugstore chain attributed the downbeat results to headwinds facing its pharmacy unit, as well as a difficult operating environment created by its pending merger with Walgreens. Rite Aid shares off fractionally, $8.44 the close.
Weight Watchers plans to launch a new ad campaign highlighting Oprah Winfrey's 40-pound weight loss while on that company's diet plan. Winfrey has a stake in the company, and she also sits on the board. Shares were up 5% to $11.08. The U.S. government put Alibaba on its blacklist of marketplaces for counterfeit goods. The company rejects those allegations. Alibaba is China's largest e-commerce company. Alibaba's shares fell more than 2.5% to $86.80.
From Zika to Ebola, predicting the next epidemic can be a lot like finding a needle in a haystack. But the medical community is making advances at a faster pace than ever before. Meg Terrell has tonight's Modern Medicine report.
New outbreaks of major infectious diseases have dominated the headlines in recent years, and for a good reason.
If you just look at, let's say, from 2013, which is only 3 years from 13 to 16, we've had chikungunya in the Caribbean, we've had Ebola in West Africa, and now we have Zika in the Americas. We've seen emerging infectious diseases forever. We have them now, we always will have them, but to have a cluster like that is a bit unusual.
In the last decade and a half, the world has coped with SARS, H1N1 influenza or swine flu, Middle East respiratory syndrome, chikungunya, Ebola, and now Zika. Public health researchers say it's a certainty there'll be another.
As much as we were unprepared that Ebola was going to explode as it did, that Zika was going to come along so suddenly, presumably the next pathogen could well be something that we haven't anticipated.
So how can we be better prepared? It's a question global health authorities have been asking since Ebola erupted in West Africa, ultimately killing more than 11,000 people.
We coordinated a lot during the Ebola epidemic, and we had a joint experience of really the tragedy that occurred in West Africa and our frustration that we couldn't do more to intervene.
At the same time, pharmaceutical companies, governments, and nonprofits were working together to produce experimental vaccines and therapeutics at a faster pace than ever before.
We were able to do, in 7 months, go from primate studies to phase 3 trials in thousands of individuals in Liberia. Normally, that takes anywhere between 5 and 10 years.
Trials for Zika vaccines are moving at an equally fast clip. But in both cases, the work began after the threat emerged.
The only way to be prepared and ready is to make vaccines against agents that we know exist, that we know have the potential to be outbreak agents like Ebola. And they're waiting, and that will happen at some moment. Let's make vaccines against them during a peacetime, if you wish.
It's a problem no single company, foundation, or government agency can solve alone. There are simply too many potential threats and too few resources in one place. So CEPI was formed, the Coalition for Epidemic Preparedness Innovations.
Well, CEPI is a novel partnership between both public and private sector entities that's really focused on preparing for potential future epidemic threats and doing it in a way that really is fundamentally different from previous opportunities where the mode has been far more reactive rather than proactive.
It has two main goals: start work now on identified future potential threats and develop new vaccine technologies to be able to respond quickly to unknown threats.
What we'd like to see in about 5 years is that we would have 2 or 3 of the key pathogens from the World Health Organization list of serious threats, where we have now a vaccine which can be stockpiled. And we'd like those at least to have, let's say, 2 new platforms that they are produced on.
The National Institute of Allergy and Infectious Diseases' Dr. Anthony Fauci says these kinds of efforts are vital to protecting the world from whatever comes next.
We will continue to see outbreaks as the years go by. They're unpredictable in their frequency. We don't know if it's going to happen next month, next year, or a few years from now, but inevitably it will happen, and that's the reason why we need to be better prepared.
For Nightly Business Report, I'm Meg Terrell.
Coming up, it's getting late. A procrastinator's guide to last-minute shopping.
Does this sound familiar? It's December 22nd. You're still short a few holiday gifts. Panic starts to set in. Did you write this for me, Sue? It's a familiar feeling, but as retailers try to increase shipping speeds, for some, it may not be too late to have those presents delivered after all. Courtney Reagan with the happy news.
While many retailers are working on getting you online orders faster, same-day service isn't much of a reality yet, even though many are using modern-day couriers for that last-mile delivery for online orders and shipping from their stores. So we decided to see how it works. So we've got some last-minute shopping to do to fulfill the items on our office charity wish list. So we're going to use some same-day delivery options in New York City, but we're looking for pretty generic items like cookware, women's socks, diapers, tools. Shouldn't be that hard, right? We started with the traditional retailers, including Target and Macy's, looking for same-day delivery options. And while same-day store pickup was available, neither could deliver us the specific items we wanted the same day. So we turned to Amazon. Amazon's Prime Now program offers 2-hour delivery for about 25,000 items. That is, if you're willing to pay the $99 annual Prime membership fee and live in one of the 30 cities where it's available, like here in New York City. The selection is more limited than the full site, but I was able to get almost everything, from cookware to tools. I needed 2 bottles of men's cologne, but was only able to get 1. I placed the order just before 2 p.m., and we had a camera at the Prime Now facility to catch the order being fulfilled, which happened in 8 minutes. The earliest free delivery window was from 4 to 6 p.m., so while I wrapped other gifts, the delivery person left the facility around 2:45 p.m. and jumped on the subway with our items in a big orange backpack. He got to me around 3:10 p.m., 50 minutes earlier than the window and just about 90 minutes after I ordered. He scanned the items and off he went. Cowen and Company analyst John Blackledge estimates there are 5 million Prime members using Prime Now 3 times a month on average, with the 30 Prime Now cities covering 50% of U.S. GDP. Blackledge estimates each delivery costs Amazon about $9. It's worth it, he says, because Amazon is the only major retailer to have figured it out so far, and it may just be saving Christmas for many, too. For Nightly Business Report, I'm Courtney Reagan in New York City.
There's hope.
There's hope. That's pretty good.
It is pretty good. Wow. That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathis, and thanks from me as well. Have a great evening, everybody, and we'll see you back here tomorrow.
Nightly Business Report has been funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do